Hey guys, Marcel LeBlanc here, Certified Financial Planner, and today I want to talk to you guys about investing and the risks involved with different types of investments. Now, for the typical investor, investing in their RSPs or investing regularly through regular deposits, outside of speculative investing and real estate investing, there's three core groups of investments one can put their money to work in. The first would be cash. Now, cash is your typical savings account at the bank or maybe a GIC, but something guaranteed by the bank that has a certain interest rate attached to it, but nowadays pretty much paying almost 0% interest for the time being until interest rates go up. The next up on the scale as far as risks would be bonds. Bonds are debt to a certain company or a certain government. These entities need cash flow to operate, so they will call on investors to inject them with cash and will promise an interest rate or a cash flow back to them as they can operate and pay them back. So you're kind of acting, as the investor, you're acting like a bank when it comes to bonds. Stocks, on the other hand, you actually have a little bit of ownership with a given company. So you're buying stock in order to own a piece of future profits. So the risks involved with stocks are pretty obvious. If the corporation goes bankrupt, you're pretty much last in line to get whatever's left after they've paid out the bondholders, the banks, and whatever other loans they might have, which might not be left if they go out of operation. So bonds are obviously appear to be safer because you get paid before the stockholders, all right? And cash, we already said, is guaranteed by the bank. Now, for this reason, bonds seem to be fairly steady, not much volatility there, not much up and down. Stocks, on the other hand, tend to go up and down quite rapidly. So the reason you want to know this stuff is because you want to own a little bit of all of these into a well-balanced portfolio. The reason behind that is that once you understand the risks involved, you can decide how much of each you want in your portfolio or in your investments. And the reason you don't want to commit too much to one is because when stocks are going up, bonds are typically going down because people will when there's more money to be made here, people will get out of here to go here. And vice versa. When stocks aren't doing so well, bonds tend to do well because people avoid the stock market mess or whatnot and will go to the safety of the bonds. So if you own a little bit of all of these, you can kind of spread out your risk and profit from the ups or the advantages of each ones, as well as balance your risk overall. Working with a well-knowledge advisor will help you because sometimes there's opportunity to be found between investing maybe a little bit more in stocks or a little bit more in bonds to be more defensive. So when you have that discussion with your advisor, you can usually shuffle a little bit or change how much of each you have in your portfolio to take advantage of the current market environments. So if you have any questions regarding investing or personal finances in general, feel free to contact me directly by visiting marcelleblanc.ca. Thanks again, guys. Cheers.